Have you ever wondered why so many people fail at investing? It isn't because they're unintelligent, it isn't because they don't work hard, and it certainly isn't because successful investing is some secret reserved for the wealthy. The truth is much simpler. Most investors fail because they become their own worst enemy. Every year, millions of people open investment accounts with excitement and optimism. They promise themselves they will invest consistently, stay patient, and build wealth for the future. Yet only a small percentage actually stick to that plan. Some panic during the first market correction. Others constantly chase the newest opportunity. Many simply give up because they don't see results fast enough. The market doesn't defeat them. Their own decisions do. And that's exactly what we're going to explore today, because understanding why investors fail is often more valuable than learning how successful investors win. If you can recognize these mistakes before you make them, you immediately give yourself an advantage that many people never develop. Let's begin with the biggest misconception about investing. Most people believe investing is primarily about choosing the right stocks. They spend hours searching for the next big company. They watch financial news every day. They follow social media influencers who promise unbelievable returns. They believe success comes from finding the perfect investment. But history tells a completely different story. The greatest investors in the world rarely succeed because they constantly discover hidden opportunities. They succeed because they consistently avoid making terrible decisions. Investing is not a game of brilliance. It is a game of discipline, and discipline is much harder than intelligence. Imagine two investors. Both have the same income. Both invest the same amount every month. Both start on the same day. The first investor checks the market every few hours. Every headline changes his mood. Every price movement influences his next decision. The second investor checks his portfolio only occasionally. He follows a long-term plan instead of short-term emotions. 10 years later, who is more likely to have built significant wealth? Not necessarily the smarter investor, the calmer one. This brings us to the first reason why most investors fail. They confuse activity with progress. Many people believe that successful investing means constantly doing something. Buying, selling, adjusting, reacting, changing strategies, making predictions. It feels productive, but in reality, constant activity often creates worse results. Professional studies have repeatedly shown that investors who trade frequently often earn lower returns than investors who simply stay invested. Why? Because every decision creates another opportunity to make a mistake. The market rewards patience, not constant movement. Think about planting a tree. You don't dig it up every week to check whether the roots are growing. You plant it. You water it. You give it time. Investing works the same way. Yet many people expect results within weeks. When those results don't appear, frustration begins, which leads directly to the second reason investors fail. They expect investing to make them rich quickly. This expectation destroys more portfolios than almost anything else. Social media makes it even worse. Every day you see stories about someone doubling their money, someone buying a cryptocurrency at exactly the right moment, someone turning a small investment into millions. What you don't see are the thousands of people who tried exactly the same thing and lost everything. Success stories spread faster than failure stories. This creates a dangerous illusion. People begin believing extraordinary returns are normal. They're not. Real wealth usually grows quietly, slowly, almost invisibly. That's why compounding feels so disappointing during the first few years. Growth appears insignificant. Then something remarkable happens. Time begins doing most of the work. The investors who become wealthy are often the ones who simply stayed invested while everyone else kept searching for shortcuts. Now, let's talk about something much more dangerous than market crashes. Your emotions. Most people believe they're rational, especially when money is involved. Unfortunately, research consistently shows the opposite. Human beings are emotional decision makers. We simply create logical explanations afterward. Fear and greed have influenced financial markets for centuries. Nothing has changed. When prices rise rapidly, confidence grows. People become convinced the market will continue rising forever. They invest more aggressively. Sometimes they even borrow money to invest. Then the market falls. Confidence disappears almost overnight. Those same investors suddenly become convinced everything will continue falling forever. They sell, usually at exactly the wrong moment. This emotional cycle repeats generation after generation. Not because markets change, because human psychology doesn't. Successful investors understand something extremely important. Their biggest competition isn't other investors. It's the voice inside their own head, That voice constantly whispers, maybe you should sell. Maybe you're missing a better opportunity. Maybe everyone else knows something you don't. The investors who learn to ignore that voice gain an enormous advantage. Not because they predict markets better, because they control themselves better, and self-control is one of the rarest investing skills in the world. There's another mistake that quietly destroys long-term wealth. Comparison. People compare portfolios, compare returns, compare lifestyles, compare investment choices, and comparison impatience. Impatience. Imagine you've invested consistently for 3 years. Your portfolio is growing exactly as planned. Then a friend tells you he made 50% in 6 months trading a completely different investment. Suddenly your strategy feels slow, boring, even wrong. So you abandon your plan. You chase the faster opportunity. Months later, you're starting over again. This cycle happens every day, not because the original strategy failed, because comparison destroyed confidence. Successful investors understand that wealth is personal. Your financial goals, your timeline, your risk tolerance, your plan. None of these should depend on someone else's results. The moment you begin investing according to other people's expectations instead of your own plan, you've already lost control. And without control, consistent wealth becomes almost impossible. There is one more mistake that quietly destroys more investors than almost any market crash. They don't have a system. Instead, they have opinions. Every morning they wake up and ask themselves, what should I do today? Should I buy? Should I sell? Should I wait? Should I change my portfolio? Every decision becomes emotional because there are no predefined rules. Professional investors understand something that beginners often ignore. Good investing decisions are usually made long before money is invested. They happen when you create your plan. How much will you invest every month? What assets will you own? How much risk are you willing to accept? When will you rebalance? Under what circumstances will you sell? If these decisions are made in advance, emotions lose much of their power. Your system makes the decision for you, and systems are always calmer than people. Now let's discuss another dangerous habit: trying to predict the market. People spend incredible amounts of time asking the wrong question. What will the market do next month? No one knows. Not economists, not television experts, not billionaires, not artificial intelligence. The future has always been uncertain, and it always will be. Yet every year, millions of investors believe this time will be different. They wait for the perfect moment. They wait for lower prices. They wait until the economy feels safer. They wait until the news becomes positive. Months become years. Years become decades. And while they wait for certainty, they miss opportunity. Successful investors understand something much more powerful. They don't need to know what happens next month. They only need confidence that productive businesses will continue creating value over the next 20 or 30 years. History has rewarded that belief again and again. Markets rise, markets fall, economies expand, economies contract, wars happen, technology changes, governments change, entire industries disappear while new ones emerge. Yet, despite all of this uncertainty, disciplined long-term investors have continued building wealth over generations. Not because they predicted the future, because they accepted uncertainty as part of investing. This brings us to another important lesson. Many people think successful investing requires courage. It doesn't. It requires consistency. Courage appears only during difficult moments. Consistency appears every month, every paycheck, every investment, every decision to continue even when nothing exciting is happening. Consistency is what allows compounding to work. Consistency is what transforms ordinary incomes into extraordinary wealth. And consistency is impossible without patience. Today's world trains us to expect immediate results. Food arrives in minutes. Information arrives instantly. Entertainment never stops. But wealth refuses to follow those rules. Real wealth grows slowly. Sometimes so slowly that you begin questioning whether anything is happening at all. That's exactly when most people quit. Not because the strategy failed, because their expectations failed. The investors who eventually succeed understand that progress is often invisible before it becomes obvious. Think about a plane leaving New York for London. During the first few minutes, the destination seems impossibly far away. The view hardly changes, but every mile matters. Every hour matters. Eventually, the destination appears. Investing works exactly the same way. Small, consistent actions repeated over many years eventually create results that appear extraordinary to everyone else. But there was never a miracle, only consistency. So, why do most investors fail? Not because markets are unfair, not because investing is too complicated, not because only wealthy people have advantages. Most investors fail because they let emotions replace discipline. They chase excitement instead of consistency. They compare themselves to others instead of following their own plan. They react to headlines instead of focusing on decades. They search for certainty in a world where certainty doesn't exist. And perhaps most importantly, they underestimate how powerful small decisions become over long periods of time. Here's something worth remembering. The market doesn't ask whether you're brilliant. It doesn't ask where you went to school. It doesn't care how many books you've read. The market rewards behavior, patient behavior, disciplined behavior, consistent behavior. Those qualities are available to everyone, regardless of income, regardless of age, regardless of experience. If you've made investing mistakes before, you're not alone. Every successful investor has. The difference is that successful investors learn from those mistakes instead of repeating them. They stop trying to outsmart the market, and they begin focusing on controlling the only thing they truly can control: themselves. Because in the end, the greatest investment you'll ever make is not in a stock, not in a fund, not in real estate. It's in developing the mindset that allows every other investment to succeed. Master your emotions, trust your system, stay patient, and give time the opportunity to do what it has always done: reward disciplined investors. Thank you for watching. If you found value in this video, subscribe to the channel and join us in the next episode of the Systemic Wealth series, where we'll explore one of the most powerful forces in investing: how fear and greed silently shape every financial decision you make.